Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for joining us today on Real Estate 360. It's nice to have you back with us. RE360 is your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m., along with my co-hosts Joe Kuchera and Lori Graymont. Please make sure you tune in to those days or get us on our podcast on RE360radio.com. Or for my programs, you can go to TomWilsonProperties.com, or you can go to iTunes and look up the interviews with their special guests and their different subjects from the past. We have a great program for you today. We have Robert Campbell, an economist, good friend, and someone we've followed for a long time and who's helped us make some good business decisions in real estate investing. Robert is an economist that graduated from UCLA in economics and also has an MBA. He has a newsletter that he writes that is one of my favorite that I religiously read every time it comes out, and he has a book on market timing. And we're going to go right into the program because I know there's a lot of content here that you'll enjoy today. It'll give you a better feel for what's going on in the world of real estate, especially as it applies to economics and vice versa. And we'll certainly have some takeaways on what you should do about it. So, Robert, it's great to have you with us. Welcome to the show.
Thank you very much, Tom. I'm looking forward to this.
So, Robert just flew up from San Diego, and he's got a couple other events up here to do, and we were fortunate to get him to come into the studio today and talk to us a little bit. So, Robert, how'd you get started in real estate?
I got started in real estate because I was born on a building site, Tom. And I say that, kind of jokingly, but it's more true than not true because my father has been a builder-developer his whole life, and he was in the business for 50 years. He's 89 years old, still strong, but he's not building anymore. So I've been around the business, the profession my entire life. When I was a little kid, even 5, 6 years old, I'd go to the lumber yards with him. That's how I bought my first Porsche. I learned how to swing a hammer for kids that are 15 years old, and I got paid a lot of money for swinging a hammer, and I could buy a car. So I love the business. I've been around it my whole life, and more importantly, I've been through the ups and downs of the business. So I know that not only from my own personal experience, but family experience. It's a tough business, and if you don't get the timing right, if you get the timing right, you can make a lot of money. If you get the timing wrong, you can lose a lot of money.
So you had some early mentors. Some people rebel from what their parents dragged them through, and others flourish from it. Sounds like you flourished from it.
Oh, my God. There's nothing turns me on more than be on a building site to hear a skill saw, the smell of sawdust in the air, or a tractor moving dirt around, or a concrete truck. There's nothing quite like building, and it's still a very strong passion of mine. I built and developed for 10 years on my own account. I quit doing that because I changed my lifestyle. Now I'm in a lifestyle that I can do whatever I want, whenever I want to, and I'm not tied to a day-to-day program of running building site, which is important to do if you want to make money.
It's a great industry, but by golly, if you throw darts, you'll win sometimes, but you may not get the net positive result. You really need to understand the economics and market timing and so forth, and you've done a great job in helping people to understand that.
Right. It's one thing coming from an academic background. I have to tell people if having a degree in economics from a good school, it's another thing having firsthand experience, not only myself, but with my family through that business. So I've probably forgot more about real estate cycles than most people will ever know. But from the time I was a little kid at the dinner table, we had some great years, Tom, and we had some bad years. We moved into some expensive spec homes during the bad years, and during the good times, of course, we're living it up and going on vacations. During the bad years, we're eating beans. So that's the nature of the industry.
It certainly is, indeed. Well, we've both seen a lot of cycles. You've probably seen one more than I have since you grew up in that business in your family. But we've seen a lot of up and down cycles, and indeed, you can't change the cycles. You have to understand them and make the most of them. Either back off or go full bore and enjoy it. Well, certainly in California now, there were those that predicted that it would be forever before we'd see things come back, but it's going like gangbusters throughout the state. We've got Silicon Valley that's leading the nation in many respects in job growth, and I guess you can take two perspectives on it. One is, gosh, it shouldn't be happening, or two, well, here it is. Let's go grasp it with both arms and make the most of it. No, it won't last forever. But right now it's good, and let's keep a keen eye on it to see when it starts to slow. But right now it's good. So so tell us a little bit about what you feel is driving the housing prices up.
Well, to a very large degree, I should say that it's driven by Fed policy, Tom. That our interest rates have been driven down to record lows, and if that is, they've been driven down artificially to record lows through the quantitative easing programs. And right now, the Federal Reserve Board is purchasing 85 to 95% of all the new Treasury offerings. So it doesn't matter whether these things are AA, single A, triple A, or whatever. The Fed's going to buy them at full price and keep interest rates at an artificially low level. Also, from a standpoint on that's driven up demand because it's made housing, it's driven affordability, driven that to record highs. But also from a standpoint, Fed policy, they came out with about a couple years ago and said the banks don't have to mark their property to the market, and in fact, that they could use their own market timing and their own discretion as to when they put those properties on the market.
Amazing.
Amazing. So that means they're sitting there with inventory that they would have been penalized terribly, historically for owning, and they can just keep that stuff on their books for as long as they want. But it's not surprising at all because it's bankers helping bankers.
Talk about a major impact on the supply-demand ratio and relationship.
Absolutely.
That's major.
Demand's been driven up because of low interest rates, and supply's been driven down to ultra lows because the banks don't have to get rid of their REOs.
Where would interest rates be now if it did not have the Fed forcing it down? Where do you think the natural level would be for?
Probably mortgage rates wouldn't be 3.5. I say they'd be 5.5. They're still not going to be, they're still not going to be screaming high because the economy's still very weak. This has been a recovery that's been very fragile and is struggling along. And if you look at employment figures, nationally, there has been no recovery. And of course, there's other factors that drive interest rates too, besides business conditions. But I would estimate they'd be 5.5%. And for every percent that mortgage rates fall, that increases a borrower's purchasing power by about almost 11%. So we're talking about housing prices at 5.5% could theoretically be 22% lower than they are today, and that's probably true because incomes have been flat to down since 2008.
I've noticed in your newsletter that I look forward to with every issue that you indicate that most people understand the concept of when interest rates go down, that makes housing more affordable. But a lot of people struggle with understanding it the other way around. Can you talk about that a little bit?
Absolutely. What's the sword has two sides to it. So what takes it down? Lower interest rates. That when interest rates go up, that could completely reverse those gains and turn those gains into losses. And because this hasn't always been the case, but in the recent past, this is the first time that we've seen actually falling incomes because of the 2008 financial crisis. I mean, that real incomes are down 8.8% since 2008. So if interest rates weren't falling, if interest rates weren't falling, it's going to take falling interest rates just to hold the status quo because people are earning less money.
So if they start, when they start going back up, it's not an if, right? It's a matter of when.
Well, and if we look at the bottom in mortgage rates was in November 2012. They hit bottom at 3.3%, and today they're around 3.8%. So we're talking about half a percent already. I don't think this is going to turn into a full-blown rise unless we turn into a major economic crisis, like a foreign exchange crisis, because the Federal Reserve, that if interest rates start rising, we're done.
And then you have this, so on top of the rates going up, you've also got this lower earning power of people, right? So that's really adds on top of it, doesn't it?
Adds on top of it. It's like putting, adding fuel to a burning fire, because they've got to drop rates. They've got to drop rates to make housing more affordable because incomes are going down. They haven't gone down a lot, mind you. But there's a lot of unemployed people. So in general, what the Fed's trying to do right now is to drop interest rates, goose housing prices, and hoping that this is going to, restart the economy.
So how long do you think they can keep kicking this can down the road?
I think they can keep kicking this can, the housing boom down the road until the 10-year yield gets to be about 1.75 to around 2%. No, actually, a little bit lower than that. But they can only drop interest rates so far, and then it's going to stabilize at that, and then the boom's going to be over. And then we'll see what's happen. Then we'll see what happens. But we got to watch the data. Just closely monitor the data all along. I don't like to forecast about where things are going. I mean, I have some ideas where I think the economy's going long term because there's some even bigger factors on there. But short term, calling the trends. We just look at the data because the markets, whatever market you're following, whether it's the stock market or the real estate market, Tom, the market is its own best forecaster. Don't think, look.
And watch it very carefully and watch for the changes. Right?
Watch for the changes.
Yep. What about new housing starts? See that starting to climb a little bit.
Yeah, new housing starts. New housing starts are doing very, very well. I think they're up 16.5% year over year, and that's the best way to measure trends, especially in slow-moving markets like real estate. Year-over-year trends. So, all the key factors with respect to a bull market in housing are positive. And not only are they positive, they're gaining momentum at this point in time. Now, can that change? Absolutely. That can change at any point in time, but you've got to call it like it is.
Robert, let's come back in just a moment here after the break, and let's talk a little bit more about the economics factors that affect these things, and we will chat a little bit more about that. We have Robert Campbell with us today, economist up from San Diego, who is on the program with us, talking about what's going on in the real estate world and economics and what we can do about it. We'll be right back after the break.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Okay, welcome back. We're very fortunate to have Robert Campbell here with us today. Noted economist and real estate timing expert. Robert, before the break there, we were talking about what's going on in the housing marketplace. Let's talk about the low inventory. Let's talk about home price affordability. Let's give our listeners a little overview about where they are.
Great. Well, which one would you like to start?
How about let's just talk about the low inventory here. We've talked about how the banks, with the mark-to-market restriction taken away from them, has certainly affected the supply significantly. And I guess one factor we haven't talked about, although you and I did before the program, is what little inventory is out there now from that is being absorbed, at least the lower prices segment is being absorbed by hedge funds.
Absolutely.
So turnkey providers and investors like myself who want to get product are having to compete with the hedge funds who are putting in, who are buying things at caps of 5 and 6%, assuming they're going to sell it for 3.5%. So in 5 years. So
right.
that's a bet I don't want to make, but it is what it is. And
the Fed has forced this on that all of us as Americans. They've dropped with their zero interest rate policy that they put into play in 2008. That everybody's reaching for yields. You go and let's say that you go and out and a lot of wealthy people used to put their money in 90-day Treasury bills. You know what 90-day Treasury bills yield right now? Like 5 basis points. Almost zero. And if you want to roll 1 or 2 year CDs, you're talking about 0.25%. So, in other words, if you have $1 million of capital, which most Americans do not have, and you want to roll 1 or 2 year CDs, you're going to get $25,000 a year, or $1,000 a month for $1 million worth of capital. That's not going to cut it. I mean, so now what people are doing, that's why the hedgies have risen to meet this new demand. They said, we're going to buy all these houses, and you don't have to get 0.25% per year on your money for a safe investment. You can buy houses that are at the low end of the market, and we're going to give you these at a cap rate of 5 or 6%. I mean, they're obviously invested in a risky asset, but that's what people are doing. They're reaching for yield. They're buying the stock market. The people are buying the stock market because it's going up. They're buying housing because it's going up, and they're buying these other assets not because they like doing that, because that's the only place that they can get a decent yield for their retirement.
Let's talk a little bit about our addiction to cheap money. We touched on that before. Let's expand on that a bit more. We've got something close to $100 billion now, isn't it? A month. It's being $85 billion at the
the Fed's pumping into the money.
Yeah,
right. They're
with no cut in expenses.
Right, none at all. That in fact back in 2012, I think it was with QE3, the Fed committed to buying $45 billion worth of mortgage-backed securities per month. Then two months later, I think it was in December 2012, they had QE4, and they said we're going to bump that by an additional $40 billion. This is minimum now, as we see it. And in fact, the last 2 months, that's been up, close to $100 million, $100 billion per month that these guys are pumping. These guys are pumping money into the system to keep interest rates low.
From a social standpoint, we many of us feel that maybe this isn't the best thing to do, but it is what they're doing. So we have to understand that and know how to work our investments to take advantage of it, don't we? This
is their game. This is that all we can do is play the cards that are dealt to us. So that we're definitely in the last 12 years have been in a boom bust economy. We've had 2 stock market booms and two stock market busts. We've had a real estate boom and we've had a real estate bust. Now we're in the early stages of another real estate boom that at some point will go bust again. And I'd like to mention that to everybody here, because this is a situation where we are going to, getting away from this next bust to protect your profits, I think could be as important, if not maybe more important, than it was in 2006 when I advised everybody to exit the market.
Yeah, so I think that's a very good point to expand on a little bit, and we'll talk some about if the housing prices fall or the interest rates fall and what's going to happen to the U.S. economy, and also talk about, when we get back, about the demographics of the baby boomers and how that's going to impact things. We've got Robert Campbell with us today, economist from San Diego, real estate timing expert with us here at KDOW 1220 AM, Wall Street Business Network, and we will be back with you in just a couple moments.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Thanks for being with us today with our special guest in studio, Robert Campbell from San Diego, economist and real estate timing expert. Before the break, we were starting to address the what interest rates would do and how it affect the economy. So let's talk about that a little bit. If rates rates go up, we may have housing prices fall. And what about the whole U.S. economy?
Well, as we were talking during the break, that for every 1% drop in mortgage rates, housing prices that increase the purchasing power of a borrower by 1%. No, by 10%, 10 to 11%. In other words, so that's what's fueled this housing market. It's made housing, the affordability factor is up near record highs. In fact, I hit a record high in January, and we're off 10% from that record high, which isn't anything significant because it's still up in the sky high. But if interest rates start backing up, this is going to, it's really going to put a damper on housing appreciation because that's what's driving it. In addition, it's going to hurt the economy very badly as well, for significantly, because there's so much debt in the system. The government national debt's up near $17 trillion right now, and I think their average. I think they're paying like 2.5% is their blended interest rate return. And if interest rates should go up, I figured if interest rates would go up from current rates up to 5 or 6%, I forget the exact number, but that would add an extra $500 billion per year onto the national deficit. That's a big number. So what I think is going to happen? I think the Fed has painted itself into a corner here, where they have no choice but to defend the system and save the system by keeping interest rates low. But at some point in time, that's going to reverse, just kind of like it's reversing in Japan right now.
Mm-hmm. And of course, another problem is that if they increase interest rates, which I'm sure they got some smart people, they recognize that that's where the natural market would be. But if they do, then their own debt service on their own debt might get to the point where they start to struggle with their ability to cover that.
They'd be falling on their own sword, Tom.
Yep.
That's essential. So that's why they're going to fight it all the way to save the system, to keep interest rates, unnaturally low. And frankly, it's a Frankenstein experiment, and they're just hoping for the best because there is no good solution.
Yep. Let's talk about the two ways to create economic growth, which kind of gets into the Keynesian versus Austrian, but we're not going to get into those details other than let's talk about debt consumption versus savings and investment.
Right. The classic way to grow an economy is where savers are rewarded for putting savings in the bank, saving money, and they get a 5 or 6% return, and that money is used by the banks to lend out to businesses that create jobs. Okay. That 5 or 6% return would raise interest rates up to such sky-high levels that the economy would collapse from that. So what Bernanke has decided to do, it's pure consumption. I mean, he's decided to keep interest rates abnormally low and hope that that will spur consumption, and because we're in a consumer-driven economy, that will spur the economy.
And a more organic, healthy recovery would be if we were increasing production, right, and savings and investing with that money.
That's what's going to create jobs, Tom. Yep. We're not creating any jobs at all. In fact, if you look back at where we are back during the bust in 2008, there's 33 million more Americans since that period of time, and we have like 4 million less jobs.
Let's go talk about the demographics here when we come back from the break. We have Robert Campbell with us today from San Diego, who's an economist and real estate timing expert on KDOW today, 12:20 a.m. at Wall Street Business Network. We'll be right back in just a couple of moments to continue conversation with Robert.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Robert Campbell with us today, economist and real estate timing expert up from San Diego. So nice to have Robert with us. We're talking about how economics affect real estate and vice versa. They seem to be more intertwined now than they ever have been in history. And if you're investing in real estate or considering it, if you don't understand what's going on in economics, you're going to make more mistakes. So it's very, very critical to understand. We're really addicted to this cheap money. It's like taking more drugs to kick a habit, isn't it? But
right, exactly right. And we're going to find out what someday we're going to find out what the real economy looks like when we stop with the cheap money. And it's like somebody that's on drugs, Tom, and he goes through withdrawal, and then you find out what that person's really like. The same situation is going to be with the U.S. economy. If we would stop the artificial stimulation, we'd find out what the real economy is like. And based on what I know, you're not going to like what you see.
I just wish we were stimulating from the production side instead of the consumption side.
Absolutely. Production creates jobs. Consumption, all that does is feed the Chinese economy, which is soon to overcome the U.S. economy as the world's #1 economy.
So what's going to happen as baby boomers move into this retirement phase? What we have, like 10,000 a day or something?
10,000 baby boomers per day are retiring and going on either Social Security or Medicare or both, whatever the situation is.
Well, I don't know if it's going to change drastically, but it seems to me when people retire, they don't spend quite as much money as they do when they're working.
That's a leading question. That's called baby boomer demographics, or what I like to call the destiny of demographics. And here's the way people behave. When people are their prime spending years are between the ages of 35 and 60 and 65 years old. That's when they spend. That's when the kids are, they're earning the most money they can. They're spending the most money on their kids, on their college education, everything. They're peak earning. They're buying new cars. But after they retire, that 10 years after they retire, consumption falls by an average of 28%.
Wow, that's a lot.
In a consumption-driven economy, the U.S. economy is driven by 71% consumer consumption. That's a big number, Tom. So, in other words, I've mentioned that we're in the decade that we're currently in is the slowest growing economic decade since the 1930s, and with all these baby boomers retiring, that the Fed has almost no choice but to keep the pedal to the metal, to keep interest rates low, to keep pumping money into the economy, and try to to stimulate consumption in order to keep the economy afloat.
What's going to stop it? When will they stop doing that? Will we have to come to catastrophe in order for them to stop?
Absolutely. We're going to have the dollar's going to crash.
Do you think that eventually at some time that we're probably just going to have to accept that we have a lower standard of living?
Absolutely. We're going back to what I like to call the Leave It to Beaver days. When the Cleavers were living in a 1,700 square foot house. Ward Cleaver was the only one that worked. The wife, she just took care of the kids. They had one car, and I think to a large degree, this is what existed when you and I grew up,
yep,
right?
Indeed, absolutely.
And so, if you go back since the 1980s, what we've been living on essentially is we've been living on debt. You subtract the debt, the debts have been fueling the consumption, and now we've reached the point that we've just saturated with the debt. We can't pay the debt, and you're seeing. And if you want an example of what's going on, just look to Europe, look to Greece, look to Italy, look to Spain, look to France. It's coming here. And we're just going to have to accept the fact that the economy's going back. It's going to reset itself to a lower standard of living, and then it's all going to be based on earned income, just like when you and I were kids and our dad was growing up. They didn't finance everything. If they couldn't write a check for it, they didn't buy it to a large degree. Not anymore. Instant gratification.
So, Robert, I'm going to ask you something that I know you're not probably not going to be comfortable in answering directly, but give us some kind of feel for what you think the timing is. Are we looking at another 2 or 3 years going like we are? Do you think we can stomach it for 10 to 15?
This is a very subjective call, as you know. However, there's a lot of other macroeconomic events, factors that we haven't touched on. That's a whole different story. But I would guess that in the next 5 years, 10 years at the outset, that we will have a calamity similar to the 1930s that will reset the economy back to normal, where we can start growing again organically, and that will be the new, and then we'll take off again. But that period of time is going to be very, very painful, Tom, for people that are in the wrong asset classes.
Yep.
So it's going to be extremely important to be an active investor, watch the trends, move your money into rising trends, out of falling trends for the next 10 years, and just hope for the best.
So what do you think are some good, maybe some good hedges? What should people do about this if with that in mind? And I guess right now, things are going well. Grasp the fact that things are going up. Carefully pick what you're going to do, but position yourself to not expect it to be like this for forever, right? So what are some things they can do?
I think California that owning anything tangible. I think that once the dollar starts a significant decline, you're going to be out of dollar-denominated assets and into physical tangible products. I like real estate. I like a lot of things. I like metals. I like food. Anything like that.
Oil and gas, maybe?
Oil and gas? Oh, absolutely. The essentials of life. Food, energy. You can't buy health care, but those are things that people are going to need. However, where you pick your real estate for a long-term investment is going to be real tricky too. I know you're part of the world that you invest in. Dallas, if I had to say, would I rather have a long-term investment in Dallas, Texas on a buy and hold versus California? I'd pick Dallas. I'd pick Dallas over California any day.
Yep,
because it's lower priced, and versus the high priced markets that we have here in California.
And fundamentals are strong.
Fundamentals are very strong in Texas
for long term, not just
long
short
term. Yep. Absolutely.
All right, Robert, we'll be back and wrap up on some more hedge things to do, what you should do with this information in just a couple of moments. We're on KDOW at 12:20 a.m. This is Real Estate 360, and we'll be back in just a couple minutes to continue with Robert.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Thank you for being with us. What a special program it's been with Robert Campbell here, economist, who helping us navigate what's going on and what to do about it. During the break, we were talking a little bit about Fiat Economies, which is certainly what we're dealing with right now. What historically has happened in Fiat Economies?
In the history of the world, Tom, any fiat monetary system, all fiat monetary systems are backed 100% by confidence and trust. Not one of those systems has ever failed to exist. I should say every one of those systems has collapsed. That's why I'm so confident about what is going to happen. The timing is hard to pin down, but not once in the history of mankind has a fiat system not collapsed, and that's what's going to happen again this time. And there's an old saying in the markets, and I've been a fan of the markets my entire life. It's that the best way to predict the future is to study the past. So it is going to collapse.
Yep.
It is. And there's going to be a lot of people that are just going to go right into the brick wall and without even blissfully ignorant, and that's what people like you and I are trying to prevent.
And some hedges are getting some tangible hard assets.
Hard
right?
assets.
Yeah. Real estate, maybe some gold, oil and gas,
food-based.
Yep. Get out of paper.
Get out of paper.
Especially U.S. paper.
U.S. paper, right.
Yep.
Well, all paper currencies around the world are going to burn. I mean, the yen's going to burn. They're all going to burn. When we have this collapse, it's going to be a global collapse. It's going to be a resetting. It's just like, who's going to be the best after that?
So I'm going to tell you from my experience, you can't afford not to. You may not like to hear what you're hearing, but you need to know it. So, Robert, tell folks how they can get your newsletter.
Okay, my website is www.realestatetiming.com. And it's as easy to get to as it sounds. No dashes or dots, realestatetiming.com. And there's a link on there for my market timing letter.
And so tell them what that is.
Every 2 months, I write a 10-page market letter that talks about, I track 17 housing trends throughout the United States, 3 of which are in California, San Diego, Los Angeles, and San Francisco. And I tell you, using the 5 key indicators that I present in my book, Timing the Real Estate Market, I track those, and it tells you not only what the trend is, but when to buy and when to sell.
And you whip that little newsletter together in about 15 minutes, right?
Yeah, like 15 days.
But it is loaded with graphs, and it's Robert's a very fact-based guy, and his newsletter reflects that. It's one of my favorite reads every few weeks, and I highly recommend it. So, Robert, thank you so much for being with us. Also, you can go if you want to hear this review again. There's a lot of data we threw at you. So if you can go to tomwilsonproperties.com, you can get hold of the podcast, or you can go on iTunes. And also, if you go to tomwilsonproperties.com, you can sign up for a weekly newsletter that gives you a little snapshot about what's going on in the general real estate marketplace. With regard to economics. You can also ask for a report on how to choose the best metro and product for investing in real estate. And if you have questions or suggestions for guests or subjects, please let us know about that. So it's been great having you with us. We look forward to having you next time. Robert, thank you again for being with us. It's been a great program. And we look forward to maybe doing one of these again before too long.
I hope so. I've had a lot of fun. Thank you.
Great. It is fun. And I look forward to having you on the next program. And remember, the only thing that matters is what you do next. Thanks for being with us. Bye-bye.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.